Here's how you can get mortgages under 3% interest rate in 2023. The way you do this is with something called assumable loans. These are mortgages where you can take over the payments from the seller of the home. Here's how it works. For example, let's say you're looking to purchase a home that's worth $800,000 and it has a loan balance of $650,000 at 2.5% interest rate. With an assumable loan, you can take over that $650,000 loan as long as you are able to come up with the difference of that loan and the purchase price, which in this case is $150,000. But if you're able to do that, you get to keep that $650,000 mortgage at 2.5% rate, whereas the market rate could be 6.5%. Now, how do you find homes with assumable mortgages? It's pretty simple. Any FHA or VA loans are assumable. For both of these, the requirements are that the home that you purchase is going to be your primary residence. So you can't use assumable loans to buy an investment property unless you're buying a multi-unit property with up to 4 units, but you still have to live in one of them and use that unit as your primary residence. The other requirement is you had to come up with the difference between the loan amount and the purchase price. On a home that doesn't have that much of a difference, more people are going to be eligible to take over that loan and use the assumable loans. But if there is a big difference, for example, if it's $1 million home and the loan balance is $500,000, you had to come up with the $500,000 difference to be able to take over the loan, which a lot of buyers that are looking at $1 million price range might not have $500,000 in cash for their primary residence. But on the other hand, if the loan balance is $850,000, more people will be eligible. If you don't have the money for the difference, you could possibly come up with other ways, such as borrowing from a family member or getting a gift from a family member, a second mortgage, or even seller financing. You also had to qualify for the monthly payment of the loan that you're taking on from the servicer of the loan. Keep in mind that since you're taking over the loan, the length of the loan is going to be whatever was left from the previous seller. For example, if the seller had a 30-year mortgage but had the home for 4 years, that means there's 26 years left, and that's how long your mortgage is going to be. Basically, any FHA or VA loans can be assumed by the buyer of that property. The buyers don't have to be a first-time home buyer to qualify. For assuming the veteran loan, you don't even have to be a veteran to assume the loan. Now, VA loans are a little trickier. It has to make sense for the seller of that home with the VA loan. Now, VA loans are a little trickier. If you're not a veteran, there's a little bit more steps you have to go through. So it has to make sense for the seller of that property to let you assume that VA loan. But in some cases, it makes sense for the seller. Now, if you're a veteran, there's no extra steps you have to go through, so it's pretty easy for you. So if you're a veteran looking to purchase in Southern California, feel free to reach out to me. I'll try to find you some homes with assumable loans. If you're not in Southern California, you could reach out to me and I can get you connected with one of the agents in my network who is familiar with assumable loans. For FHA loans, it's pretty easy. There's no downsides to the seller. If anything, letting buyers assume FHA loan is better for the seller because they might be able to get a higher price for their property because the buyer's monthly payments are lower. For example, a house that was recently on the market here in city of Orange, it was a $930,000 home with a $730,000 loan balance, which was assumable at 2.5% interest rate. The market rate was 6.5%. If someone was purchasing that home at a 6.5% rate, their monthly payment after principal, interest, tax, and insurance would have been $5,600 a month, whereas a buyer that's buying it at 2.5%, their monthly payment is just $3,900. That's nearly $1,700 you're saving a month. That's $20,000 in a year. Plus, if you have a mortgage with 2.5% interest rate, you probably would never have to refinance that mortgage in the life of that loan. In the case of that property, had all the buyers known about it, they might have bid up the price of that property because at the end of the day, buyers are concerned about their monthly payment, and that property has a very low monthly payment. So if you have a property that has a VA loan or FHA loan with a low interest rate, your home might be worth more in this market. Here's the advantage to you as the buyer. Most of the buyers in this market don't know about assumable loans. So when they're bidding, they're taking into account their higher monthly payment, whereas you're competing with the much lower rate than what they're competing at. This allows you to bid higher but take on a much lower monthly payment. FHA loans tend to be more common in some areas more than others. For example, there tend to be more FHA loans in Riverside County than there are in Orange County, but if you know how to find them, they're still there. Now, a realtor that knows how to work with assumable loans will be able to find properties on the market that has an assumable loan such as FHA or a VA loan, and they could do the work to figure out what the rate on that loan is. If you don't have a realtor and you're looking to purchase in Southern California, feel free to reach out to me. I'll put my number up here. If it's outside of Southern California, I could help you connect to a realtor that does know how to work with assumable loans. Hope you found this useful. Comment any questions that you have below. Subscribe for more real estate tips. I'll catch you on the next one.